Hello, everyone. Thanks for joining Strictly Money. I'm your host, Sejal Patel. If you're a crypto investor who is betting on becoming an instant millionaire overnight, these past few weeks have no doubt been a wake-up call. The crypto crash, as it's been dubbed, has wiped off more than $1 trillion in wealth and has put pressure on regulators to impose stricter rules on the industry to protect investors. My guest on today's show has been an active member of the crypto community for well over a decade, as well as being an advisor to the Ontario Securities Commission. Brian Mossoff is the CEO of Ether Capital and joins me now to discuss recent events and the trends to watch for this year. Brian, it's great to have you on.
Thanks for having me here. Always happy to talk about crypto, whether it's up or down.
Well, it's down. It's been down a lot. So what's your take on what's going on? How should we be reading into this crash, as we call it?
So there's no question that the asset is volatile. It's been volatile ever since inception, and it probably will continue to be. Many new investors to the space are not used to this kind of volatility. We've seen, almost a 50% pullback since this round of the all-time highs. And the real question that I always want to emphasize to investors is, do you have conviction in this? Is this something that you believe as a technology is going to be bigger in 5 years or 10 years than it is today? Mm-hmm. And if you do, then it can be a piece in a portfolio, but it doesn't have to be everything. So I think a lot of people FOMO'd in, these are investors who might have came around in the latter half of 2021, thinking it's just going to keep going up. And it's going to pull back. It's going to be volatile. So it's really important to adjust your time horizon and think about, is this technology something that they want in the portfolio for the long term?
So Brian, it's so interesting that you said technology, right? Because at least there was so much conviction, at least with Bitcoin, that it was a hedge against inflation. It was the next gold. Doesn't seem that way. If anything, Bitcoin, as well as some of the big popular ones, have been more correlated to the NASDAQ and the tech plays. Is that a fair assessment?
I think that the narrative around Bitcoin being digital gold is something that's been around for a while. Whether it's ready for prime time now to act as that hedge, I'm not sure. Again, this is still acting very much as a risk-on asset. I do think that Bitcoin will continue to act as a bit of a check on central banking policy. Again, whether it's volatile in the short term is correlated or not correlated, I'm not sure. I think we're seeing that it currently is acting very much correlated to the rest of the market. But over time, I would expect it to untether because I think it does have some unique properties that it can fulfill that mission of being a hedge against bad monetary policy around the world.
Brian, do you think, can you label crypto like as a whole space? Like some say it's a currency, some call it a commodity. What's your take on that?
I think that that's an almost impossible question to answer because there's so many cryptocurrencies and they have different functions, and the way investors hold them or use them can make them different, right? Some people treat something like Ethereum as gas, right? It's the tool to pay transaction fees as they're trying to participate in decentralized finance or purchasing an NFT. Someone may hold Bitcoin because they just see it as a commodity. I think it's still unclear, how to bucket these things, and regulators are challenged with this exact question of who's responsible for the oversight of trading, how the exchanges should be overseen and registered. That's still something that people are grappling with. And you still see various agencies fighting over who has jurisdiction over which assets and which platforms they're traded on. Yeah,
well, certainly the crash has raised serious alarm bells, and so much so that the Biden administration is now expected to issue an executive order on cryptos. How do you see that playing out?
I'm not sure that any of the government actions are about the volatility of crypto. I mean, that's something that is concerning, but the big question is how to regulate this asset class, how to regulate how people are going to purchase these assets, what the on and the off ramps are going to look like, what compliance looks like, what kind of reporting obligations they should take on, whether it's to the IRS, whether it's to a securities commission. No one knows. And that's what they're trying to figure out now. You also have things like stable coins, which are tokenized dollars that move around the blockchain. And these are things that maybe investors in the mainstream don't realize how big these numbers have gotten in the last couple of years. Tokenized US dollars that might have been just a few $1 billion moving around blockchains are now into the hundreds of billions of dollars. So there's real money happening here. There's real movement of funds through these blockchains. Ethereum cleared almost or is on track to clear almost $20 trillion of settlement this year. I mean, this is something that once was thought of as an experiment and a niche little piece of technology and has grown into a real asset class, a real piece of technology. And there's a lot of things to work out to see that come to fruition. And there's a real opportunity here for the US to lean into the technology, but in a very respectful way of the existing laws and regulations.
Welcome back. I'm here with Brian Mossoff of Ether Capital. Brian, do you think the best days for Bitcoin are behind it? And I ask this because I'm constantly hearing and reading that Ethereum, which is the second biggest crypto, has more utility.
I think that both of these assets are going to continue to do well in the long term. Again, what happens in the short term in terms of volatility, no one knows. We could still see a big pullback from this point. I think, again, in a 5-year time horizon, what are these two assets really doing in the space as a whole? Bitcoin, I think, has cornered the narrative around a check on monetary policy. It has this hard cap, digital gold things surrounding it that people are buying into. Again, where the price goes in the short term, I don't know. It'll continue to play that role, though, in the long term. Something like Ethereum, though, is giving rise to a host of really interesting applications: decentralized finance, NFTs, stablecoin movements across different countries or data centers. There's a lot of opportunity for a blockchain like Ethereum. Now, you do see something like Ethereum have much higher usage in terms of the transaction fees that are being paid to use that network every day. Okay. And that may have some investors saying, I want to make a bet on Ethereum different than Bitcoin because I think it fills a different value proposition that's really exciting. And developers are flocking to something like Ethereum because you can do more with it. It's a more flexible structure, and that's really exciting. But it doesn't mean that it means that Bitcoin is dead. It just means that they're fulfilling different use cases in the marketplace and in the crypto portfolio for investors.
So, Brian, can we step back in and can you explain what Ethereum is, and also this idea around proof of work versus proof of staking and how that fits in?
Sure. So the main difference between Bitcoin and Ethereum is that Bitcoin at its core does not have a very flexible programming language, meaning you can't ask the blockchain, the Bitcoin blockchain, to do very much on your behalf. So I can't send to a friend next week, half of a Bitcoin and ask the network to execute that for me. Ethereum came along a number of years later and said, if you make that base layer more functional, if you put a better programming language in it, then you have something more like an operating system. And you can think of this like your iPhone that's running iOS, and there's different applications. And the heart of the iPhone is that operating system that all these applications can run on. So that's what makes these two blockchains different. And people are really excited about the kinds of things that you can do on Ethereum. There are other competitors to Ethereum, but the point here is that smart contract platform, that flexibility is really exciting. And so in the latter half of last year, you saw a lot of people excited about NFTs and the metaverse. And all that activity takes place on a blockchain that has a more functional programming language in it.
Okay.
Now,
go ahead.
You want to go into the proof of work versus proof of stake question?
Yes.
So this is also kind of complicated, but we can break it down into people have to validate transactions. People are performing various activities on these networks. They're buying NFTs, they're trading, they're moving funds between different addresses. All that activity has to be secured somehow. It needs to be put into the blockchain. And so proof of work means that people are running computing hardware and electricity in exchange for the tokens that are being part of the inflation schedule. So in Bitcoin, it's Bitcoin. In Ethereum, it's newly minted Ether. And so proof of work means that they're spending electricity and computing hardware. The commodity essentially is external to the network that they're putting at risk in exchange to validate the transactions. In proof of stake, what's really exciting here is people who hold the native token Ether are able to essentially put that into a bond with the protocol and take turns validating. So it's more democratic, it's more energy efficient, and they can generate essentially a yield on their Ether. Currently, it's about 5%. At Ether Capital, we think that this is a very big deal as people are concerned about the energy consumption of proof of work networks. There's a real opportunity here for these next generation networks like Ethereum to allow participants to generate a very attractive yield while holding a token that they are very bullish on in the long term.
So we only have about a minute left before the end of the interview. Brian, when I look at Ethereum price, the last I checked, it was about $3,300. I think me personally, what I struggle with is for something that has utility, how do you even begin to evaluate it, right? It's not like a traditional stock where you look at the balance sheet and you look at future cash flows. How does someone start looking at it and even understand what's fairly priced?
So this is a question that I've been asked essentially since 2012, 2013, and it's almost impossible to answer because there is no direct metric that you can draw to decide this is the correct value today. Now, what you can do, though, is I think reframe the question a little bit and think of it as an option on a very smart group of individuals who are building some really interesting applications. I liken Ethereum to New York. And there's all this infrastructure that's popping up. There's a lot of activity happening there. There's a lot of developers happening there, and they're building the roads, they're building the traffic lights, they're building the sewer system, they're putting some buildings in. And we're not exactly sure what it's going to look like in the next, 5 or 10 years. Okay. But I think it's clear that there's momentum there.
Welcome back to Strictly Money. Do you like wine? I'm sure many of you watching like to drink it, but how about investing in it? Once seen as reserved for the wealthy, more and more retail investors are looking at wine as a core part of their investment portfolio. And as you're about to find out, for good reason. Joining me now is Atul Tiwari, Chief Executive Officer at Cult Wines Americas, a fine wine collector and investment management firm. Hi, Atul. Great to have you on.
Hi, Sejal. Great to see you again. Thanks for having me.
So, Atul, I was doing some research for this discussion, for this interview, and I was actually surprised to learn that the Livex 100, which actually tracks the price of 100 of the most sought-after fine wines, it grew 21% last year, and it's actually more than the Dow Jones Industrial Average, which was up 18%. So, big surprise for me. Why has wine performed so well?
Well, Sejal, it really comes down to supply and demand dynamics. There's only a finite amount of fine wine or investment grade wine made every year. And as time goes on, consumption decreases that supply. And on the demand side of the equation, as more wealth is created around the world, more people drink wine, more geographies, countries that traditionally weren't wine drinking countries become wine drinking countries, that demand pushes up the price as supply goes down. And so that's an axiom. And once you go beyond that, we have found over the last couple of years with the pandemic, certain types of wine are being consumed more than they were pre-pandemic. And so when you looked at the index, you probably noticed that champagne performed the best of any sub-index, up about 41% last year.
And it's interesting, you talked about the pandemic, and that's what I was looking at, because like you said, prices go up when demand outstrips supply, and then yet there was a lot of places that were shut, right? You didn't have as many in-person events, restaurants were closed. So was there something else, some other dynamic that was playing out?
There are. And so taking champagne as an example, when the pandemic hit, the council that governs the region decided to decrease production because they thought demand's going to go down. But in actual fact, demand went up because a lot of people said, why wait until my birthday to open a nice bottle of champagne? Let's have it on Thursday night. So demand went up, supply went down. And then we entered last year where there was a dramatic climate change impact in Champagne with frosts that came and destroyed about 50 or 60% of the crop. So the 2021 vintage is going to be substantially reduced as well. And so when you have additional reduction in supply, but increased demand, again, prices go up. And then, of course, there were the supply chain shocks that made it harder to actually buy and acquire champagne.
So going forward, Atul, then when it comes to that supply, do you see that similar trend? I mean, you talked about weather shocks, and that has to be playing in, I have to think, global warming, all these different weather patterns. What sort of demand supply dynamics do you see, 5 years from now or 10 years from now?
Right. It's obviously very difficult to predict the climate. But that said, over the last few years, we've seen various shocks. as a result of climate change. And so France was impacted in 2021. California had wildfires. Germany had floods. All of these events conspire to reduce the amount of wine that can be produced. And so one of the factors that we consider in our investment analysis is, in fact, the climate. It's an important macro factor to take into consideration when you're analyzing investment grade wines.
Okay, we have about a minute until a commercial break. One of the golden rules, diversify your portfolio. Can you talk to us about how wine fits in? Because my understanding, it is a low correlation, has a low correlation to stocks.
Absolutely. There's a number of great investment merits beyond the ability or potential to earn good returns. Those are what you refer to, low correlations to equities and bonds, low volatility, and when compared to equities and gold, for example, and what we call the low downside capture. So what that means is that when the equity markets go down, fine wine doesn't move nearly as much. And we can show that through the LiveX experience during the global fiscal crisis, as well as the first couple of months of the pandemic.
Welcome back. I'm here with Atul Tiwari of Cult Wines Americas. Atul, I want to talk about your company, Cult Wines, because you have made investing in wine a little bit more accessible to retail investors. Can you tell us about that? What's a minimum investment? How does one get started?
Sure. So Cult Wines was established in 2007 in the UK, and we have about $390 million of assets under management. 6 offices around the world and about 80 people on the team. And so what we offer is a segregated, separately managed portfolio of wine. We will onboard you and match a wine portfolio to your risk profile and time horizon. And what you get is an actual portfolio of wine. You own the wine. And what we've found is that 80% of our clients will sell the wine for investments, and about 20% will take possession of the wine for their own enjoyment. But we will actively manage that portfolio for you. And we have made it more accessible by reducing the entry point to $12,500. So you can onboard with us at that amount. And at the $45,000 amount, you'll have a dedicated portfolio manager managing your account and working with you on regular portfolio reviews.
So, it doesn't sound like there's a minimum investment period, or is there? And what sort of fees come with that? Because I have to think, managing wine, the storage, logistics, that all plays a role.
Right. Yes. So there's no minimum period. We don't have any hold periods or lockups. But we do advise our investors to take a 3 to 5 year view of their portfolio to give wine a chance to appreciate. Ideally, 5 years would be a great time horizon to think about. And in terms of what you get, at the $12,500 level, it's 2.95% management fee. At $45,000, it's 2.75%. And for that, you actually get the acquiring of the wine that we do. We transport, we store it with perfect conditions with a third party that is in the business of wine storage. We insure it. We actively manage your account and give you advice. So as far as alternative investments go, as an ex-Vanguard guy, I would say it's a pretty reasonable price. And we don't have any performance fees, and we don't charge commissions on sales.
Atul, you talked about investment grade wines, right? This is what it is. So how does your team do its due diligence? What are like 1 or 2 things that they look for?
Well, we have a global investment committee of which I'm part of, and we meet quarterly. So we get inputs from our data team that covers such things as climate, like we talked about, critic scores, critic critics rescoring the wines, the brand, the number of bottles produced. And so a lot of data goes into it. But then beyond that, we overlay a human fundamental look at each particular producer and their wine, because we do spend time with the producers on the ground. So it's an interesting way to analyze each investment. And we have our own system, which is called a quality to price ratio. So if the bottles or the producers that year meet our QPR, we will take that on board as an investment for our clients.
Atul, we only have about 30 seconds. Where do you see the most opportunity with wine? What regions?
Yeah, we're still very keen on Burgundy, very keen on Champagne, and excited about some of the new regions that are coming into play as the market broadens. And those would be some wines that we find investment grade in Chile and Spain. So it's important to keep a diversified portfolio, as you mentioned.
Okay, and growth strategy?
For the company?
Yeah.
Yeah, we're aiming to get to about $1.5 billion in 4 years' time. And we've just really started in North America. It's an untapped, incredible potential for an asset class that's already established in Europe and Asia.
All right. Atul, thanks for coming on today.
Great. Thanks for having me.
Atul Tiwari of Cult Wines Americas. Thanks for watching this edition of Strictly Money. We'll see you next time.